It's not having a good record keeping system and a bookkeeping system to keep accurate records, right? Because if you have accurate records, you can sit there and say, why is that expense so high? And also by having the records, you're making sure you're not missing expenses that you could be entitled to from a tax saving standpoint. So again, documentation, if that's like that's the one biggest thing people can do. That's the most boring thing they want to hear.
Good morning. Today we have Thomas Castelli, a CPA and CFP. He's a tax strategist, a real estate investor, recognized as a CPA practice advisor 40 under 40, and an emerging leader with NYSSCPA, a partner at Hall CPA, and a co-host of Tax Smart REI podcast with more than 4 million downloads. He's worked with over 100 plus investors and has experience both as a sponsor on an 82 unit apartment community and also a limited partner in many multiple syndications. Thomas, thank you so much for being with us, and make yourself at home.
Thank you for having me. It's an honor to be here today.
So you are a very highly recognized CPA, and you're also an active real estate investor. What's made you jump out of just being an advisor to your clients and start investing yourself?
So yeah, let me unpack that a little bit. I'm more of a passive investor as it stands today, but I have been an active investor in the past. But I'll go ahead and I'll just give you the journey, because the investing journey actually preceded my CPA journey a bit. It started for me way back in college. I started reading the Rich Dad Poor Dad books and went down that entire rabbit hole. And what I found is that a lot of wealthy people are invested in real estate in some way, shape, or form. So when I was when I graduated college, I had an internship with a large accounting firm, and then I accepted a full-time offer that following fall. So there was a group that I had met through a real estate RIA event, a local RIA event, and they did real estate syndication, and they were doing a 3-day weekend, like an educational weekend on real estate syndication. I said, you know what, before I start my full-time job, let me go to this 3-day weekend, see what syndication is all about. And when I went to the 3-day weekend, they broke down how to find deals, how to invest in deals, raise capital. It was like a crash course, so to speak. And I really fell in love with that business model. It's okay, I want to get involved. So I started going to their monthly meetings, and there was a gentleman who was part of their program. He had approached me about investing perhaps as a limited partner. So me and my parents actually put some money into the deal, and he gave me a behind the scenes look at what it was like to be a general partner. So I seen how the deal was closed. I was on property management calls, went to visit the property, all these different things. So although I wasn't a general partner, I was not responsible for the deal. I was getting like a behind the scenes look. Then the same group ended up a few years later doing like a crash course, like a mentorship program. And I was like the guinea pig. And through that, I actually found a property, connected, smiled and dialed, pick up phones, called brokers, property managers. And we eventually found an 82 unit apartment community that we believe there's some meat on the bone. There's something there, right? It hit our buy box, and I brought it to my mentor, and he agreed. We knew the property manager. And we went ahead and put in an offer on that. And long story short, we ended up acquiring that deal. And in 2017, went full cycle. By May 2020, I could go down a whole rabbit hole here. But while that was all going on, I was also on the CPA track and working here at Hall CPA and becoming a partner. I don't know if that answers the question. It's a long-winded question.
It did. So basically you got a ticket to how to make it all work. So you got an actual inside seat, which is unusual. Most of us don't get that. So because you're still doing the CPA track as well, how does sitting on both sides of the table help you guide your clients through what most people see as an intimidating world of real estate?
Yeah, because I've been there, done that. I can trust test when people are like where they're not seeing things, right? Syndication is a big undertaking. It's certainly achievable, do not get me wrong, but it's not exactly as easy as buying a single family rental or a small multifamily yourself. You have to raise capital, you have to do legal, you have to network, there's a lot of moving pieces. What I'm able to do is not only just tell them, hey, from a tax perspective, this is what you need to do at XYZ stage, but also, hey, did you think of this? Did you think of that? Hey, maybe you should go get those legal documents. Sometimes someone came to me recently, I'm going to do a syndication, but I'm not going to get a private placement memorandum, a PPM, which is the legal document that protects the general partners in the event of the unforeseen. Yes, I was like, you know what? I think you should go get that PPM, right? I'm not an attorney, but I think you should go get that PPM. Just little things like that. Being on the other side of the table allows me to give some insights that a normal CPA or typical CPA may not see because they've not done it.
So I'm a real estate broker. So I always prep my clients for what's the next step. So usually they're coming to me either first time home buyers or they're repeat buyers. And we talk about, okay, how do you build your wealth? Is the house that you're currently in one that you can keep and then go and buy? So a lot of people, I tell them, can you float both mortgages? Can it start building your wealth in being a rental or starting you down that role? So we're always looking for that. And our listeners want to see massive ROI, return on investment. What's one simple strategy that an everyday real estate investor completely overlooks?
Okay. What I could give two. I could give one, but it's a cheap one, but it's a strategic one. Okay. Look, at the end of the day, I'm in a big belief of surrounding who, not how. I don't know if anybody's ever heard of that book, but surrounding yourself with the people who are experts in certain areas so that you're not only making sure you're doing the right thing at the right time, but rather than trying to figure it out yourself. So mine is going to be the number one strategy you can get if you're looking from number one tax strategy is working with a tax strategist or an advisor. Why is that? Because they're going to already know the playing field. They've already seen your situation or situationally similar to yours dozens, not hundreds of times. And they're going to know exactly what to do and what not to do to position yourself for success. So the number one thing I would say is if you're getting into the game of real estate, go work with a tax strategist who's already seen this playbook, who can just tell you pinpoint exactly what you need to do. So you can go, hey, you're capturing tax savings, you're not making mistakes, and you're spending your time on what really matters in moving your investment journey forward, which is probably finding deals, maybe raising capital, maybe obtaining financing, maybe managing or asset managing the existing portfolio that you have. Those are all much more higher value activities than trying to go it alone. So rather than trying to say, oh, here's the one strategy that's going to unlock for you, I would say that's the number one place to start. That's the number one strategy. Find somebody who can move the mountain for you, so to speak. If the other one I was going to mention is document everything from bookkeeping to anything that you're doing. I can't say how many people miss out on tax savings or things like that because they just don't have the right documentation. It's very boring, which is why I talk about it. But it's hard for me to say, oh, the real estate professional status or short-term rentals or this or that is going to be the strategy for everybody here. But if you work with the right person, they'll be able to help you identify what that is.
We always try to tell people, don't rewrite the story. Other people have done this, fallen on their faces. Learn from them. Don't fall on your own face. And then always bring receipts. Oh, you always want the receipt.
Yeah, I'll tell you a situation right now. So this is not real estate related, but I had a traffic ticket back in 2022 that I just got a notice yesterday that I did not pay. I did not pay. So I called my attorney and I was like, what's going on there? Like, their system has been broken for the last 3 years. Now they're sending this all out. The problem is I cannot find the record of paying this, right? Which is very unusual for me because I'm very prompt in all my payments. But I'm like, where is this record? The fact that I don't have that documented now puts me in a position where I'm likely going to have to pay this triple fine. I know this is not tax related, but similar situations all the time if you can't substantiate a receipt in front of the IRS. So documentation is key.
How early in the buying process should someone, and I think we answered this already, but how early should someone start planning their tax strategy to avoid leaving money on the table?
Yeah, it depends. It definitely depends. I could argue that the investment strategy that you choose to deploy it can impact your tax strategy. So starting with somebody right on the precipice in the beginning could help you pick an investment strategy that is more tax advantaged than maybe what you would have been able to consider on your own. So I can make the argument you should do it right away, right when you're first starting. Get somebody on board when you're first starting. The other thing is definitely by the time you're about to acquire a property. Because at that point you want to make sure you're doing everything right from the first. Here's a situation that came up recently. Somebody acquired a property that right before in January of last year. And because they acquired in January, they're not able to tap into 100% bonus depreciation, which is a major lever of tax savings because of the acquisition date. Had they acquired it 2 weeks later, they would have been eligible. So by having somebody just say, hey, if you're thinking about acquiring this right now, you may want to punt this a little bit, or you may want to consider postponing whatever you want to do. So I think the earlier, the better. And usually if you're seriously committed to real estate and you're like, hey, I want to be serious about this, I could say right when you make that commitment, that's when you start looking for somebody for help.
So even with first-time home buyers, that's one of the things that we talk about, is that you want to start building a team. And when you're building a team, it's not just the real estate agent and the lender, but it's also a tax strategist. It's also a CPA. You also want to talk to the attorney and the insurance person. You're actually building a team of people who do this every day. So we're always wanting to make sure that we get rid of the misinformation, because good Lord, there's so much out there on TikTok and everything else. Yes. We try to make sure that you have a team that you're comfortable with and that work together well.
Yes, 100%. And especially if you're going to be doing several deals and this is the first one of many, you want to make sure you get that team early, and they can build. Once you do, it's going to be it's going to be upfront work, doing the due diligence, building relationships, putting that team together. But once you build it, you can take that with you as you grow throughout your journey.
Think about, what was the movie, the Kevin Costner movie? If you build it, they will come.
Yes.
It's the same thing. Okay, so one of the big leaders that people think about, especially when they're moving to our area. I'm in the Charlotte, North Carolina area. We have amazing taxes on real estate here. And so we get a lot of transplants, New York, California, Illinois, all of this. And so real estate taxes are, one, a driver, but can also be extremely overwhelming. What's a big misconception that new buyers have about taxes when they're purchasing their very first home?
Like their primary residence or like an investment home?
Either one.
Okay, so I'll go with the investment one first, because the investment, one of the things where there's a lot of misconceptions. A lot of people are confused with how taxes work on an investment property. So when you buy an investment property, you're pretty much buying a mini business. So you're going to have your rental income, your revenue, and then you're going to have your operating expenses, things like property management, advertising, repairs, maintenance, legal, accounting fees, so on and so forth. Those all get deducted from your revenue or your rental income. And there's also one expense called depreciation. That's a non-cash expense. It only exists on paper. And thanks to accelerated depreciation methods like 100% bonus depreciation, you can easily have a very sizable loss that you're reporting to the IRS, despite the fact that you may have actually cash flowed positive from a cash perspective. So what ends up happening is people say, what happens to this loss? A lot of people, this is where people get confused. So if you're back in the Tax Reform Act of 1986, they introduced the passive activity loss limits. And what that said is that losses from passive activities can only offset income or gains or capital gains from the sale of other passive activities. Now, by definition, rental activities are passive by default. So they're stuck in the passive bucket. So unless you're a real estate professional, I could talk a little bit more about that in a second, but that's the biggest misconception. People think I'm just going to get into real estate and I'm going to be able to take all these losses and offset my W-2 or my other business income and save all this money. And it's not an automatic yes to that. What ends up happening is, what you can do as any real estate investor who's investing in rentals can take advantage of this, is you're sheltering your rental income from tax. So it might be generating cash flow tax-free, which reduces your effective tax rate and is tax advantage in and of itself, because most business income or W-2 income, you can't shelter like that. You're going to have to pay the taxes on it. So if you're investing in rental real estate, you're investing in tax advantage income right off the bat. So that's a benefit. Now, if you can qualify as a real estate professional, which requires you to spend more than 750 hours and more than 50% of your total working time in a real property trade or business, if you can meet that requirement, then the losses on your properties become non-passive, as they call it in the tax code, or active, as some people call it, and then they can offset your W-2 or your active business income. I think that's the biggest misconception when it comes to rental real estate investing that I've seen from a tax perspective.
Yeah. So the other piece that we've been hearing a lot about, it's a big buzzword right now, is the DSCR loans. And so a lot of investors are looking at these DSCR loans as like again, not having to raise capital. The property itself does all the work for you. Is there anything tax related in relation to that people should be aware of when they're looking at these magical loans, as the internet puts it?
So DSCR loans, they make those loans based on based on your ability to cover the debt on the property. And so they're looking at the asset, maybe not your personal credit. Now, I think it would be important to work with, and I have to imagine most people are in this space, if they're giving DSCR loans, are this sophisticated lenders I'm speaking about, work with a lender that understands that depreciation is a non-cash expense and they will add it back. So they're not, some lenders will, that we've seen, they look at the loss on the tax return and they say, oh, you're losing money and we're not going to make the loan for you, whatever the case may be. But they have to understand, and then sophisticated lenders will add that back because they know it's a non-cash expense. They know it's not real, and that they're really looking at the actual expenses related to the property. So make sure you're working with somebody on that end. But other than that, I wouldn't say there's anything that jumps out particularly for me from a tax perspective when it comes to DSCR loans.
When somebody's ready to turn that first home, their primary residence, into an investment property, what's the first financial step they need to take?
The first financial step they need to take. That's a good question. That is a good question. They need to move out of the property. I don't know if they need to list that property for rent. And I would say at that point, you have to understand that you are now entering into a business type of arrangement, a business type of activity. And I would suggest that you start documenting everything. I know I don't want to go back to that, but you need to have a spreadsheet. I would say should have the first financial step is opening a business bank account. That's the first thing that I would say. And then starting to run all of the income, have all the rental income ultimately deposited into that account, and all the expenses drawn from that account, whether you use a debit card, check, if you have a dedicated credit card, if you want to get credit card, have everything separate. Separate that from your personal situation. Because here's what happened. That's going to be reported on your tax return, and you're going to need a record of your rental income and all your expenses associated with that property. And if you have that in your personal account, it's going to be very challenging for you, for whoever this is, to go back through and have to parse out. We see this happen all the time on the accounting side, where it's like, here's 6,000 transactions, and okay, here's from Publix, here's from Noco. Okay, which one of these were actually business expenses, right? And we have to parse out. So by having the first step I would do from a financial perspective is I would open up a business bank account. That's the first thing that I would do.
That's one of the biggest things, even as a real estate agent, that we've started a business, is being able to separate what's personal and what's financial or business related. So it's a number one step with anybody who's doing a lot of this stuff, even gig work, that it is still a business and it needs to be treated that way. You have experience in scaling all the way up into an 82 apartment community, which is where most of my clients are trying to get. That's their ultimate goal. How can an everyday investor safely bridge that gap from a single family investment into larger investments?
So I would say that first is a mindset shift. You can go straight for the syndications right out of the gate. You don't need single family experience. It's helpful, but it's a different ball game when you're dealing with an apartment community, and some of the skills are translatable, but some of them it's just completely different. So you can go right out of the gate. The one thing that I would say is get a mentor, get somebody who's been there, who's done that, who can guide you along the way. There's different types of communities.
Go ahead, please. No.
There's different communities, different mentorship groups out there. I would interview a few different mentors, a few different people, a few different ways they do it, and pick someone who resonates with you, your learning style, the amount of hand-holding or the amount of support you need in the deal. And I would do that because, again, when you're raising capital, when you're buying a large or apartment complex, a lot more can go wrong, and one mistake can be very costly. So it's best to have somebody in your corner who's been there and done that, you can go to, hey, what happened? This happened or that happened, or they can tell you things not to do before it ever happens. So I would say the biggest thing to bridge that gap safely would be getting a mentor or some type of community that can support you in making that transition.
Again, you always want to follow somebody else's example so you don't make the same mistakes that they did. We always want to learn from the people in front of us.
Absolutely. We're not going to Mars here in real estate. We're not doing something for the first time.
True. So what are the top 2 red flags that new investors should look for before trusting a partner or sponsor with their capital?
Two red flags. Okay. The first thing I would say is the first red flag is a poor track record or a lack of a track record. And I understand people need to start somewhere, to be fair. But at that point, the person who was just starting should be partnered with somebody who has that track record that they can lean on. So I would look at the track record. Do they have a track record of success in the asset class that you're investing in them with, right? If it's multifamily, for example, how many multifamily deals have they had? how many of them have went successful, how many of them have failed, how did they address the ones that failed, and how often did they hit their targets from what they said they were going to do to what actually happened. That's what I would look at. Okay, you said this would actually happen, and this is what actually, you said this is what you were targeting, this is what actually happened. How many times were you right in your projections, right? That's the first thing I look at, track record. By far, if they don't have a track record or it's a weak track record, that's a red flag. Second thing I would look at is actually, there's a lot, there's frankly a lot, but also alignment of, and this is more on you, I would say, than the sponsor, on the investor, is know what your buy box is, know what your investment objectives are, and let that be the filter for the lens in which you evaluate opportunities. Because sponsor can have a great opportunity, but it might not be the best opportunity for you. And you won't be able to tell, and you might, unless you have your buy box down, unless you know what your criteria is, you might not be able to do that. So I can't say it's a red flag on their end, but that helps you identify red flags by knowing what you're looking for.
Correct. And with that poor track record, with that weak track record, it's exactly what you went back to. It's having documentation, being able to bring the receipts, show what you're being able to do.
Yeah.
So with your experience, and you've advised hundreds of investors, where do most people lose their money without even realizing it?
Ready? It's the $5 Starbucks they're buying every day. No, it is not. It's not having a good record keeping system and bookkeeping system to keep accurate records, right? Because if you have accurate records, you can sit there and say, why is that expense so high? And also by having the records, you're making sure you're not missing expenses that you could be entitled to from a tax saving standpoint. So again, documentation, if that's like that's the one biggest thing people can do, that's the most boring thing they want to hear. But I can't say it enough that having good books and records is going to be where you're going to save money. And if you don't have that, you're probably losing money without even realizing it.
It's not pretty, and it's not flashy. It's not any of these great things, but it is the foundation that you build everything on. And that's key. You have to have a good system to start with, because how do you know that your water bill is twice the expense if you don't have the records to go back and see? How do you know where that shift begins? And that's what a lot of my previous podcasters have come on. My guests have told me it's never, you don't ever gain 15 pounds with one hot dog. It's right. The 15 hot dogs or the extra cookies or the cream you put in your coffee that you don't realize. That's where the shift starts. And it's always those little things that you can catch that'll make the biggest difference.
Exactly.
What's the biggest myth that people believe about real estate taxes, and what is that misunderstanding that's actually costing them?
Yeah, I think that the biggest myth about real estate taxes, I think that they think it's more simple than they give it credit for. Or they hear soundbite clips about certain strategies and don't really understand what it actually takes to implement them. Right? You buy a rental property, and yes, there's a lot of advantages open to you, but how do you know what they are and how to take advantage of them, or what the biggest myth is going to be that people think it's just simpler than what it is. It's because, again, I can't tell you how many TikTok videos I've seen of somebody touting the biggest and best tax benefits, which may be the right video, but in a 60 second clip, they're not going to be able to fully understand what you need to do to actually take advantage of it. So people think, oh, I just bought a short-term rental property, I'm going to be entitled to all these tax benefits. Did you do X, Y, and Z that opens the door and ensures you're entitled to those? Oh, no, I didn't. It's not as simple as just buying a property. There's other things, other boxes and requirements you need to meet. So just understand that when you're elevating into the game of real estate and you're going from a situation where maybe you just had a W-2 job or a small business and you were investing in the stock market, you're now playing the game at a higher level, and things are becoming more complex and more sophisticated. And you need to respect that complexity and do the right and act like a business owner and do the things, put the team around you that's going to be able to help you navigate that complexity. So the biggest thing I would say is that people oversimplify what it really is, and they don't respect the actual amount of detail that goes into it. Same way, another analogy I could give is, okay, you think you have some type of medical condition or something, you Google it and they give you a quick fix and you think that's it, not respecting that there might be some deeper issue going on.
Or the other way around, you end up WebMDing and now you have cancer and it's a bloody nose. You need to have somebody there who can walk you through that process. I know that My accountant that I talk to a lot, I will send her TikToks and she goes, "Oh my God, go to bed. Stop scrolling and go to bed. This is wrong. You know this." But it is somebody having that person in your arsenal. You're building that team and you can always rely on them. And that's crucial. Tax, tax laws and local rules are always changing no matter where you live. What recent or upcoming legislation shifts should everyday buyers be preparing for right now? And this would probably be federally because everybody's different depending on what state they're in.
Yeah. So there was One Big Beautiful Bill Act came out last year, and that implemented a lot of changes, and that has already been permeated through the system, which is people still figuring out. But that was the biggest legislative shift. So I could say the cheap answer is go work with somebody who can help you navigate it. That's not the answer I'm going to give here. More recently, they came out with two pieces of legislation, not necessarily tax related, but I think people should be aware of. The first one is there's a FinCEN, which requires additional reporting when you're buying properties with cash. So if you are buying properties with all cash, or you're using private financing, so not from a bank, there are now additional reporting requirements that your attorney or your title company is now required to report about you. So more information will be given to the government about your situation. So it may not be as anonymous as you once thought it may have been. That's one thing. And I can't say this is for the everyday investor, but something to keep in mind out when you're starting your investment strategy. They are now putting restrictions around people who have single family portfolios or small multifamily portfolios of a limit of 350 properties per affiliated group. So I know if you're starting out, that might seem like, oh, that's so far away. But if you hit fire and your investment strategy is single family rentals, you can easily get to the point where you're hitting that threshold, and now you're like, now what?
This was in relation to the BlackRocks and those kinds of things that we're buying in neighborhoods. And during the 10, 12, 14-year strategy, then they started building entire rental neighborhoods. But that was to keep hedge funds from buying entire neighborhoods.
Exactly. And believe it or not, the percentages that I had on that were pretty low. I think 2% of the housing stock was owned by people who had that scale. But I think it was to curb that trend from becoming a bigger issue. They want homes, single family homes, to be in the hands of the buyer. And that entire bill, there's a lot more that goes into it, is designed to ultimately do that. So the reason I'm saying that is something to be aware of, is just because that might impact what investment strategy you choose today, and also downstream what your tax strategy around that would be.
Now, all right, so we've talked about tax strategy. We talked about getting ready as an investor. So just because you pick a tax strategy today doesn't mean that you can't pick a different one later, right?
Yeah, absolutely. It depends. It depends. You could certainly shift investment strategies. You can certainly shift tax strategies. Most of the time, you can change. There are certain things you can't change, but most of the time you are able to have some flexibility in that.
Because that makes a difference when someone's building their team, that if they think they make the decision today and 5 years from now, as they have grown, they can't change, that's going to make a bigger impact on who they choose.
No, you can change. You can change a lot of the tax strategies. But again, usually the more you can foresee where your future is going, or the more clarity you have in the direction, the better you can set things up from the start. So I would say that it's better to figure out front. But that said, we've seen plenty of clients, plenty of investors shift their investment strategy and then thus shift their tax strategy later on. Most of the time, it could be done relatively seamlessly, but sometimes there are things that you just need to watch out for.
True. So how can buyers adapt their strategy today to start protecting their returns for future tax changes? I mean, I wish you had a crystal ball. You could tell us everything. I always say if I had one, I'd be on a beach somewhere.
I would say is this. I would say that it's all political at the end of the day, and so who knows who's going to be in the next administration or rules they're going to be able to get across or not. But what I would say is that by investing in real estate, you are putting yourself in a good position from a tax perspective because of all the advantages that real estate has to offer, and the fact that it's the United States needs housing. Okay. So I find it very hard to believe that no matter what administration is in place, that even if they make changes to the current benefits of investing in real estate or the current incentives around it, that it would go too far awry, because again, the US needs it so bad that I just think it's one of the safer asset classes to invest in from a tax perspective over the long term, because there's like a moat around it from the fact that they can't intrude on the tax benefits too much. Otherwise, there'll be a disincentive to actually, or lack of incentive to build housing, to be an investor. And that's contrary to what the US needs where we are today, given the demographics. So I would say get in the game.
Most people don't realize how much real estate touches a lot of other economic pieces. Because if you think about it, when someone buys a house, it's not just buying a home. They've employed construction workers, they've employed lenders, they've employed furniture makers, they've employed, and so there's so many things that real estate touches that it is one of the cogs of our economic system. So people have to keep that in mind. It's like you said, there's a moat around it. It's literally one of the easiest to get into and almost one of the safest, because typically real estate doesn't depreciate most of the time, unless we have extraneous, I forgot what that word is, extraneous circumstances. Is that what I'm trying to Unless we have some really weird things happen, it's always going to go up in value.
Yeah.
Where do you see the real estate landscape heading over the next few years for new buyers or even for seasoned investors?
Yeah, so I would say that single family for new buyers is probably always a good place to get into, a good place to start, or even small multifamily. But really, if you look at the demographics, you look at the investment economics. We've spoken to a few different investors, and I think senior housing is a space to look into. Because from my understanding, I've not done thorough due diligence, but I know for a fact that demographics certainly support baby boomer generation, certainly supports the need for senior housing as we go into the next decade, so on and so forth. But also that it's extremely challenging and expensive to build these facilities, and there's a limited supply of those facilities as a result. So you have a simple supply and demand issue. If you're able to buy those facilities and either operate them or have somebody operate them, then you're going to be putting yourself you're skating to where the puck is going. So that comes down to investment strategy. So that's what I would say for seasoned investors. Definitely keep an eye on that. If you've already been in the game and you already know how to do stuff, you can take a look at that. For new investors, you just got to figure out your investment strategy and get in the game. And if you're just starting out, jumping to senior housing, certainly possible with the right mentors and guidance, but just be cognizant of the demographic shift and where things are going and what markets to invest into to capture that. Because at the end of the day, single family investing, I still think is going to be very, very powerful. Just realize again that 350 unit property cap. So if you want to scale big time, you might want to get into a more sophisticated strategy from the beginning. So that's what I would say. Long-winded answer.
I absolutely adore the fact that you're a hockey guy, because I'm a hockey girl. Sorry, I picked that up. But yes, it's one of the things that we want our folks to be able to do, is to know that you can step into this arena, and you can step into this arena pretty easily. It does have a good opening for just about everybody.
Yeah.
Ultimately, what does it mean to you to help someone feel at home and completely secure with their financial decisions?
What does it mean to me? It is great to be able to give people clarity and confidence in what they're doing and set themselves up for success. One of my missions in life is to help other people build generational wealth. So if I can help give people clarity on taxes and set themselves up from a tax perspective, then that is serving that mission, because at the end of the day, taxes are your biggest expense, often your biggest expense. And if you could knock that down, you could take that money, reinvest it to grow your wealth and do other things with that money that be better suited, perhaps. So it's part of the mission. So it's a fulfilling part of the journey for me.
Thomas, this has been a blast. I thank you so much for your time, for being here. We do have all your socials. We will put everything out. We will also be blasting you all over what we do. And I hope that you will share this podcast with your audience as well. Again, thank you for being a part of this, and I greatly appreciate your time.
Likewise, thank you for having me on today, Dee.
Thanks for joining me on Make Yourself at Home. I hope you found insights and inspiration to help you navigate your real estate journey with confidence. Don't forget to follow, subscribe, and share this show with your friends because everyone deserves to feel at home. Until next time, stay informed, stay empowered, and keep making moves that matter.